Thank you for everybody for joining us. And I know he's not here right now, but thank you to Faisal for setting this up. It's very impressive what he's put together in a 2-month period. So first of all, I'm Amit Singh. I lead Dentons West Coast corporate practice. Dentons is the largest law firm in the world. We're ranked globally number 5 for venture capital, and I focus primarily on venture capital and mergers and acquisitions involving technology and life sciences companies. And so I'm going to ask each panelist to introduce themselves and then talk about how they went from industry to venture capital. And so, Anshu, if we can start with you, did you really just, don a Patagonia vest, go to a bunch of tech conferences, talk about disruptive innovation, and say bro to various folks and the checks started rolling in, or was it a little more complicated than that?
Well, I wish it was that easy. But so I'll start with my background. I am an engineer by background. I started, my thesis was in AI when AI wasn't hot. It was, the compute was inadequate and data was insufficient. And I gave up on AI. I wish I hadn't in the 1990s. I moved to the product side, and they used to, or the business side, they used to call the dark side. Okay, when you're an engineer, that the business side is the dark side. So I moved to the business side after finishing my MBA. And I've done 5 startups, so I've been part of 5 startup journeys, all 5 pre-revenue to exit. They were acquired by various public companies, so have gone through several integrations, know what a good acquisition and a bad acquisition looks like. I've acquired several companies too while I was at these large public companies. And the last company that I founded, I was founder and CEO, was in serverless computing. And that got acquired by DigitalOcean. The investor that had invested in my company was Converge, and I got to know them professionally. So when I left DigitalOcean, I think I was 2 weeks out, and Converge called me and asked me that if I would like to become a general partner at Converge and run the Silicon Valley office for Converge. They are Boston-based, Cambridge-based, and I joined Converge after that, after a lot of thinking. So no, it was not. It was not. It was not an easy decision because I've been an operator all throughout my career. I kind of thrive in operation. I love the pre-revenue to exit. I've never taken a company public, so that was still on my to-do list. So I hopefully would live through that through my portfolio company one day, but. It was a decision that I made because I'd done the operational side. I've looked at what good investors are and what bad investors are. I had raised money from over 100 investors because I had raised money for all 5 companies. So I've known the investment landscape pretty well. And I really liked the way Converge was with the founders. It was a company friendly, helped. It was more than a check. And I wanted to be that kind of an investor. So that's how I moved into the venture world.
And Anshu, can you tell us a little bit about Converge and what you focus on?
Sure. Yeah, so Converge is an early stage B2B tech investor. We focus only on B2B, so no B2C. We focus on enterprise domains only. And the areas of focus, it's still quite wide, but with the current fund, we are looking into AI infra, cloud infra, dev tools. And also, we look into AI applications, and we also have started investing in robotics and IoT, and the convergence of robotics and AI almost 5-6 years ago. So that's also a continued investment thesis, part of the continued investment thesis. We are very high conviction investors. So because we go in so early, and we bring domain expertise and a lot of connections, and our LP base is mostly operators like yourself. So it's our check is more than just the money. It is a lot of connections, advice, help that comes out for the founders, and that's what I experienced when I was a founder, and Converge was my investor. So based in Cambridge and Silicon Valley, we invest across all these domains, and in pre-seed, seed, and early Series A, pretty early on.
Thanks, Anshu. And Hem, would you please provide us with a little bit of your background and then talk about kind of your journey into venture capital?
Absolutely. So I'm a founder and managing partner of Spark Growth Ventures. We do mid-stage tech-enabled products and service investing across US, selectively internationally. Right now, we are not leading as much, so doing non-lead checks of $1 to roughly $5 million. Roughly 4 years into inception now, 25 companies, 80% of the companies are non-Bay Area, non-New York, spread across the nation. Some are international as well. And around 45, actually as of this morning, 48 million gross AUM. So equivalent of a 50 million evergreen infrastructure from a fund point of view. We are democratizing access to venture capital by creating microfunds, few microfunds a year, lowering the minimum check size fee that's required to come in, and just through word of mouth, no marketing, no decks, no events. 1,400 plus people on 6 continents, 700 odd individuals who are investing through us from 5 continents today. In terms of my journey, it's very non-linear, much like my colleagues here. I actually started doing research with the idea of getting into academia initially, doing large-scale linear optimization and writing code, 30,000 odd lines of code, C, C++ at NCSA, National Center for Supercomputing Applications, sponsored project at Urbana-Champaign. Didn't finish the PhD after my master's, wanted to get more into the real world, not in the abstract world, so put on a hard hat, steel-toe shoes, and did a turnaround for Conagra Foods in one of the largest food processing plants in Kansas City. We had lost 6 lives early on during the turnaround, but put our heads down. We made it one of the best run plants in the meats division of Conagra, 21 plants. So we were one of the best within 2.5 years. Was also recruited by the corporate guys to go do surgical projects across Midwest, small places in Minnesota, all the way to a small place in Appalachia, Michigan, the Hebrew National Plant, etc. Then after that, a few years doing revenue management, product management work at airline, which was United Airlines after they post-bankruptcy, trying to maximize the revenue per average seat mile. So all the demand forecasting tools that you see, the global distribution systems, the seat inventory, the pricing, I was quite involved at that. At least at that point in time, they must have changed the algorithms or refined them at least. Did my MBA, went to Wall Street for a few years during the financial crisis. So again, I have a tendency of running into things when people are running out. So got, I would say, quite elevated, intense experience there. Came out, did a couple of years as executive at a private equity portfolio company of KKR here in InsurTech, where I ran 3 corporate functions and did business transformation, strategic sourcing, and buy-side, sell-side M&A. In my mid-30s, decided to actually pursue new challenges and self-actualize. Was looking to do something on my own. Initially got hired as a CEO of a healthcare holding company up north in Salt Lake City. Did that as an interim role, didn't necessarily work out from a long-term point of view. So started my first VC. So it was serendipity, it was not intentional. With the hyper-local tech focus, early stage investing in San Diego. Then left that, 2-year hiatus, did a bunch of different things. Started Spark now 4 years ago, 3.5 years of cutting, or rather investing. So that's my very non-linear convoluted route to getting into VC. I don't ever claim that it was intentional. I didn't even know about VC, to be honest, till around 10 years ago. So this has been basically serendipity and now learning pretty much on an ongoing basis. So that's a little bit around Spark as well as my journey.
Thanks, Hem. So Brad, if you can kind of give us a little bit about your background and how you got into venture capital.
So I'm Brad Greenwald, managing partner at Hilltop Venture Partners, recently of Denver, and then recently moved to La Jolla. You know, Anshu has made me very sad because she's reminded me of one company on my wall of shame, which is DigitalOcean, who pitched me about 7, 8 years ago, and I think they're worth a couple $2 billion, and I managed to say no to them. So thanks a lot for that. I sort of fell into the VC game a little bit from industry. I worked at some big companies like Time Warner and Polaroid, and really what happened was I was working at Polaroid, which it probably still is an awful company. Like they had one great invention, then they didn't know what the hell they're doing. So I just wanted to get the hell out of there. And a buddy of mine started a little startup. And so I jumped in and kind of caught the bug. So I really got into these small companies. I sort of went back and forth from big companies to small companies and started up my own, worked for a couple people, started up my own. And after selling out of a company, making a little dough, after sort of taking a year sabbatical, I was sort of trying to figure out what the hell I want to do with my life. And I just really realized I love this early stage, very creative moments for startups. And so I started investing in as an angel. And I sort of migrated into an approach. I thought eventually I would create a fund, and I realized how tough it is, and I sort of like just working on my own. So basically right now I'm a bit of a hybrid, just another path for you to kind of get into the game, where I put in my own cash into very early stage, mostly B2B, mostly between the coasts startups, software startups, but I have about 150 VCs, family offices, angels that invest alongside me, not in a fund format. In fact, I usually get sweat equity for working really closely with the company. So one of the things we were asked to talk about, I'll just bring it up now, is the things that you sort of miss from being an operator. Those of you who are operators and are thinking about getting into the VC game or the finance game, some of what you miss is sort of this control, sort of this being able to be in the mix, and so I got to say I miss being an operator. I miss some of that, having a team, running something. As a VC, you're enabling, you're advising, but you're not controlling for sure, and not having the say ultimately on it. And so I found my way into this thing where I'm a very involved advisor, and I roll up my sleeves and I get very involved. So I get a little bit of of that from that. So it's sort of a hybrid approach.
And Brad, before we go on to Al's background, while you brought it up, you mentioned angel investing and venture capital. Just so we kind of level set, if you could kind of describe the differences between what is an angel investor and what is a venture capitalist?
So very quickly, I think many of you know these, but angel investing is really you're investing as an individual, a little bit smaller checks, personal money. A fund, if you're investing as a venture capitalist, you generally are seen as having a fund. You go out and raise money from outside folks who give you the right to decide where the money will go. So you sort of get to play with other people's money. For that, you get a little bit of a fee and then some upside on the profits. When you're investing for yourself, it's kind of all yours. You do it directly. You make all the decisions, if that helps.
Yeah, no, that's perfect. Thank you. And Al, if you could regale us with your background and your path to VC.
Yeah, sure. So my name's Al Bsharah. I'm the founder and managing partner at Interlock Capital. Getting to that point it was a pretty fun journey for me. I started in Detroit as an electrical engineer in the automotive industry. And after a couple of years of that, I realized pretty quickly I needed a change of everything. And so that's when I moved to San Diego, and this is back in 1998. I joined a company as a second employee. We grew it, we sold it, and that was the beginning of my entrepreneurial journey for the next 25 years or so. I started my own company in the early 2000s. It was in the e-commerce space. I built a bunch of really cool stuff, but I was a solo founder. I made a lot of mistakes. I probably made all the mistakes. I didn't know what I was doing, learned a lot from that process, ended up going through programs like Founder Institute and Techstars, where not only was I reminded about all the things that I had done wrong in my previous company, I was also educated on what I should have done correctly and what I could have done better. And I was mentored by a ridiculous amount of exceptional people that were so far above and beyond my abilities at the time that it was ridiculous. And that's the power of kind of an accelerator program. But at the end of the day, it didn't just make me a better entrepreneur. In many ways, it opened my eyes to different ways I could be better as a human, as a person. And so fast forwarding a bit, my next company in the email marketing space, I sold it to Seismic Software and Return Path. Story for a different day, but I sold the company twice. Landed at Seismic for the next 4 years. Seismic Software is a very fast-growing company here in San Diego. The CEO speaking at one of the events today. You should go check that out, Doug Winter. But I was there from 200 people to 1,200 people in a 4-year span. So got to see ridiculous B2B SaaS growth at its highest, amount. And I was focused on the product and the operational side of the business as the wheels on the bus were, shimmying and starting to fall off and figuring out how to keep them on the bus. And so for me, this whole journey, this entire time of being an entrepreneur, I'd always wanted to be an investor, but I couldn't always write the big checks, let alone a bunch of them. And so for me, two things were really important as I was winding down at Seismic and deciding that I was probably moving into venture. I'd been doing some personal angel investments and small check stuff as well, and getting a feel for it and getting excited about it. There were two things that were really important. One, I wanted to build something unique and different in venture, not the same thing that's been done over and over. And two, I wanted it to be accessible, not just to investors who have the capital and know what they're doing, but also to aspiring angels like myself and a huge portion of my network, which is folks like us, folks like you. They're entrepreneurs, they're operators, they're just smart people. And this theme of surrounding myself with smart people that started back in Techstars continued through what we're doing at Interlock today. And so we spun up a few syndicates. We decided, hey, what happens if we invite this network to invest with us? And so we spun up some syndicates, did our first few investments, got tons of great excitement and traction, and that's where Interlock was born. We were later asked to start a fund for many of our investors, so we did that as well, and now we write checks out of a fund, and we almost always spin up a syndicate because it's very accessible and really great, smart people get involved. And so we've written 35-ish checks to 26-ish companies, about $7 million in capital deployed, and we've had 350 people write checks into one or many of our opportunities. And there are 1,000 people in the network that we leverage to help source our deals. Half the deals that we've done have come from this amazing network. They help us with diligence. We hand select the right people to dive in with us on our companies to do diligence. Of course, they can fund with us as well through the syndicate or the fund or both, as some do. And long-term support, something that's really near and dear to my heart because I've been given so much in my career. I get to say, when founder is all of us, we have new challenges every week, right? And they can ask for advice, and I can give advice, but what I get to do now is say, hang on, let me go talk to the smart people, bring somebody really specific to that challenge to the table, and let you go solve a hard problem together. And so, that's kind of the short-ish version of my story and how I got into venture.
And what types of investments do you focus on, and what business areas or?
Great question. So we are seed stage. That's our lane. We've done some Series A. We even recently did a B. We do some pre-seed, but seed is essentially our lane. Outside of that, from an industry perspective, we are very agnostic, and that's by design. I've always kind of not enjoyed the concept of starting a VC firm and limiting it to this certain window of my own personal expertise, because I don't want a great opportunity to come across, fall in my lap, and then say, I'm not smart enough to evaluate it, so I'm going to pass. So our process, if we get the right people involved, if we are able to get comfortable with that process that we run, comfortable with what comes out of it, then we're not going to be afraid of any particular industry. And because of that, we are literally all over the map on the types of deals that we've done.
Okay, great. Thanks, Al. So, Anshu, you obviously you came from industry, and how do you think that has benefited you? What kind of leg up does that give you on evaluating opportunities, being an effective VC versus if you just came up from went to Wharton, became an analyst and kind of moved your way up just on the financial side? How do you think that it kind of gives you an edge, the fact that you came from industry, that you've been an operator?
Great question. First of all, it helps in sourcing, which is probably the biggest task, in my opinion, where if you don't have access to the right deals, you can't really invest in them. So the reason it helps in sourcing is because I've been part of that entrepreneurial world for so long. We hang out in the same circles. We know about each other, who all are going to start the company or have started the company. So that really helps. But once you even source the deal, once you even have the deal, there's so much money, and I'm based in Bay Area. There's just money flowing everywhere in the Bay Area. It's full of capital. And there are very big name investors there. So if Andreessen and Sequoia and Khosla and all are in there, it's very hard for an early stage or like a small fund like ourselves to be in the running. But what really helps me in this area of investing is I bring more than the check, and that's what the entrepreneurs want. If the founder is really interested in growing, founders are always interested in growing the company, and it becomes a bigger task than just the raising the money. We bring that expertise, we bring that help to them. So a lot of times when founders are pitching, they realize that we're not just sitting on the other side and asking questions. What does a financial plan look like? What does what do you how do you think of go to market? It's not just the basic questions. There are more thoughtful questions on how can what is the go-to-market that will help you accelerate in this market, and those kind of questions and the help that comes with that. So, given my go-to-market experience, it's really been helpful for the founders that we have funded, and the new founders, they see it right away. So, my operational career has really benefits me from helping the companies in strategic, go-to-market, operational, name it. All of these areas, because I've gone through it myself. I was running my company when pandemic hit, and we didn't know when what to do when pandemic hit, because it was the first of its kind. So a lot of learnings came out of that, and when I work with our founders, I kind of advise them not regarding the pandemic, but the adversities that can happen if you don't plan for that. So that's the kind of experience the founders see if the investor has done the companies themselves, and it's not just a check.
That's great.
I'll jump in there. So as you guys know, most VCs are looking for a great team, right? In fact, you'd rather almost always have an A team with a B idea than a B team with an A idea. At least that's my experience. And so having lived and worked in startups before, I think recognizing the skill set, which I think I've stolen this little thing from some other VC, but having a hacker, a hustler, and a hipster, sort of having those personas in the founding team and sort of understanding what goes into those is really important. And then kind of having the team, especially the founders, again, having the ability to go on this emotional roller coaster. Again, anybody who's done a startup knows one day you're cranking, and then like an hour later you're about to die. And so you're living through that. So understanding skill sets and sort of personality types of people that can live through what is a very difficult process is really important. And I think I'd say, having gone through it myself, seeing people around me, seeing people who have not been able to hack it, is really important to sort of recognize when you have a good team or not.
Thanks. Hem, how do you sort of approach risk management in making your investment decisions, and how has your industry experience sort of informed that strategy?
I think first is the appreciation that risk is real. Risk is real. A lot of people actually just focus on the reward part, how big the investment returns, etc., can be. They either have never seen risk manifest, or they might have, but don't necessarily think it can repeat. So just the realization that risk and reward are two sides of the same coin itself is a big deal. And that is, I think, a lived experience. It's a acquired experience. It can't actually just be theoretical that people read about in business schools or in other platforms. So that's a mindset thing. In terms of how do you go about underwriting, you have to basically decompose every aspect of the business down to the basics, from a business model point of view to the human element to what are things that are happening in the macro and the micro markets, etc., and try to put basically some assessment around what is the level of the risk that can manifest, and if there are mitigation strategies that you can actually put together to actively manage the risk, and then see if indeed that is possible with the deck of cards that you have been handled, or the team that you're working with, the capital that you have, etc. If not, then maybe that is a big enough reason or material reason itself for you to actually not move forward. So that's essentially how I would think the risk plays into my mindset. I have actually seen risk manifest firsthand several times. Like the example I was talking about with Conagra, 3 months into the turnaround, 6 lives lost. Plant was pretty much under the gun anyways. We had 450 lives, or people who were working there, probably 3 to 4 times the number of lives that were dependent on the plant doing well. So we saw that firsthand. I've seen what has happened on Wall Street, and therefore what has happened on Main Street as a derivative of that, et cetera, et cetera. So that makes you just realize shit can happen, and be appreciative of the fact and be prepared both proactively in terms of underwriting, but then reactively or in real times working with the companies, looking through different elements and putting different mitigation levers in place.
That's great. Al, you want to jump in?
Yeah, I think there's, I mean, look, this is one of the riskiest investments you can make is in startups, right? It's everywhere. It's an art and a science trying to manage it, right? The science is like Hem is talking about, you know, it's the numbers, it's digging in, and a lot of the later stage stuff is going to focus quite a bit on that because those numbers exist. What are the metrics? How's the business doing? What does the market look like, et cetera, et cetera. And you can pattern match, right? You can know the industry very well, and you can know what you've seen in the past work and what doesn't work, and you can sort of evaluate risk that way. On the art side of it, kind of goes to what was said previously by these guys about being operators or founders or entrepreneurs, and having lived and breathed it for so long. You know, I've played probably, in my 25 years, I've probably played every role that there is in a startup company because I've had to. And so it allows me to have a view into what the founders are dealing with, not just on a day-to-day basis, but a personal basis. How do the founders interacting? Do they have the right team put together to handle the things that are ahead of them? Do they have the right skill sets? Are they approaching things correctly? Are they humble enough? Do they realize that they're probably wrong about a bunch of stuff today? And are they going to be able to figure that out in the future, right? So there's, you know, it's tricky. And that's why I think having some kind of entrepreneurial background, having some kind of operator background, it's more intuitive in finding those little subtle things that may not be written down on a piece of paper somewhere to evaluate that sort of opportunity.
Yeah, it's always struck me as really an interesting career for folks because it's one of the few careers where you're expected to fail 11 out of 12 times, and you just have to get that 12th one right, and it makes up for all the other 11 failures. It's sort of the stats you're looking at, and you really have to have a stomach for it. So while we're sort of winding down a little bit, Anshu, would you maybe give what advice would you have for the folks here, most of which are in industry, and if they want to get into venture capital, what advice would you give them on the different paths that they could try to use in order to get there?
Okay. Well, first of all, you have to go in with your eyes wide open in this. This is not at all the glamorous job that people think it is. Okay. It doesn't make all that money that people think it does. In the first 5, 6, 7 years, there's no carry, so you don't make as much money as you think that it will on the other side. I mean, I made a ton of money more as an operator than I would make for the first 5, 6 years in the venture. But the thing that's most exciting about venture is that you meet so many smart people. You meet smart people all throughout when you're an entrepreneur, but here you're meeting smart people like several times a day, and you are able. It just keeps you intellectually stimulated, and that's probably the best part of the job. So if you are deciding to make a switch, there has to be a reason why you're making a switch. If it is for the glamour, there isn't. If it is for the money right away, there isn't. Okay, it will come, but it's not. But if it is for being excited of what all is happening in the industry, and you want to meet great people, and you want to fund great companies, and you want to see them grow, it's like having your own company is having a child, and being a VC and funding several companies is having a lot of grandchildren. So that's the distinction I draw, where you don't have to you don't have to discipline your grandchildren because somebody else is there to discipline them, but you see them grow, and you still feel good and bad about how they're doing, but at least you're like 1 degree removed. And that's where you have to decide, whether this is for me or not. For me, I made a decision because I had done enough operational role, and I wanted to experience something different. I had been working. I've been in computer networking, and I've been in compute. I wanted to experience different technologies because when you are an entrepreneur, you're kind of digging the hole, and you're staying in the same domain. Here as a VC, I get to experience so many different technologies, and it's just so exciting. So my advice is, if you're serious about it, you have to have your right reasons to switch. Otherwise, operational roles are way more thrilling than the venture role.
Sure, I'll throw it on. Try it before you buy it, right? If you haven't really been a VC before, so if you have a buddy who's a VC, ask to go to some pitch meetings. Start doing angel investing, either through a syndicate like Al's or New Fund or something like that, where you can put just a little bit of money if you don't have to spend so much money you have. Or you can start cutting checks, 10,000, 25,000 if you have that kind of money. So start trying, start picking, take pitches, because you got to see 100 of these things and you start realizing, hey, how do I differentiate what these are going to do? And then you'll start following some of these companies over the year, 2 years, 3 years, and kind of see some of the stuff that's going to happen to them. So I'd give it a sort of try it before you buy it. Try to figure out if you can get a little experience to make sure it's something you do want for all the reasons, plus or minus, and see if you're any good at it.
And Hem, what would you advise folks on getting in? Like, say you want to join an existing VC fund. What would they be looking for? What are the different reasons why they might be willing to bring you on rather than somebody else?
Yeah, I think the topic of the panel itself kind of hints essentially what is valued on the VC side. It is real operational experience. A lot of people have gone from pedigreed platforms like Wharton, Stanford, Harvard, etc., go Wall Street, go private equity, or do something and get in. I don't think that actually really sets people up for success long term. Maybe financially they become successful, but from a founder experience point of view, I don't know if those experiences on average are the right experiences. But if you have to take my opinion, I'm biased. The value is actually attributed to real operational experience. So the functions that can actually really lend you to a higher probability of getting in would be, I would say, either sales or go on product or engineering, and get real experience there first, maybe in mature platforms or maybe even in smaller platforms. But to mix it up is actually very valuable. To be able to see essentially how entrepreneurial and hustle-involved platforms actually require different attributes and different skill sets and mindset, and then also go with some scaled up and more mature platforms and bring that kind of skill set or tool set to, I would say, being a VC. So if you have to ask my opinion, more than the pedigreed programs or the 2+2 kind of approach, I would say go get real world experience, and then maybe build a track record if you have the capital or if you have the network or the access through angel investing, and then network your way into VCs, and that will probably set you up well for getting at least a foot in the door. That would be my 2 cents.
Want me to add on to that?
Yeah.
Yeah, I totally agree with everything there. I would say, be willing to do whatever it takes, offer your time, get involved, ask where they need help, and be willing to do that work, right? This is also a great way to see that the grass is not always greener, because there's going to be work that needs to be done that's more administrative. And I got to tell you, I learned a lot going through this process of starting a VC firm. There's a lot of admin crap that has to be done that's complicated and difficult and not very fun, but it's an important part of the process, and it's an important part of running a good organization. And so if you're willing to dive in and work behind the scenes and help this organization, they're going to be willing to work with you and help you grow and introduce you or offer you other opportunities. So you got to be willing to do a little bit of the dirty work. So I would say just offer your time, get involved, and ask to be involved. You never know what kind of opportunities are out there until you ask. And right now, it's too easy to be an investor. If you want to be an investor, it's too easy. When I was trying to 6-7 years ago, AngelList wasn't a thing. There weren't syndicates. There wasn't low dollar value ways that you could get in. So just get out there. Just go do it. There's no excuses right now for you to not be an angel investor or VC if it's truly what you want to be.
Yeah, looks like we're out of time, but just to tag on to that, there's a lot of ways to get involved. You've got new fund was mentioned. We've got Connect. There's every city you're in, there's different organizations where you can volunteer to be an analyst. You can volunteer to be on the due diligence team and learn more, get exposed to people. And there's lots of people, really great people like the folks here, that are open to mentoring people and giving advice. Because when people become successful, they like to help others. And that's why they're willing to do these panels. So don't be afraid to ask them questions.
Thanks, guys.
Thanks, everybody.
Thank you, guys.